Earnings are strong, crypto is rising, and the data that's coming out is surprisingly pretty good. But in the light of this optimism, there are concerns to discuss. We got Trump back with the threats, the Fed fractured, and investors are pricing in a future that might already be breaking apart. So in today's video, we're diving into it all. And what we see on the day is stocks were up. And that was mainly on the moves in the earnings that we've seen. We've gotten great earnings coming in and positive economic data that we'll talk about a little later. Netflix, Pepsi, United Airlines, TSMC, Taiwan Semiconductors, they've all reported good earnings. And this is right after the big banks reported good earnings and reported that we're in a resilient economy here in the US during the start of earnings season. Today's release of earnings that we got was mainly from these companies who should have been impacted by tariffs overall, and what they reported were pretty good earnings and good forward-looking guidance, helping investors to really look past the recent tariff mess that we've gotten. So naturally, we should go back and question on whether or not these stocks are expensive or not. Are they way overvalued or not? Now, some are leaning towards probably not. So the S&P 500 is selling at 22 times forward earnings. And what this means is that for every dollar of earnings investors expect to receive, they pay $22 to own the S&P 500 index, yielding them 4.5%. Now, when we compare that to the 10-year Treasury yield of 4.447%, that's barely a move on there. So this guaranteed yield from the US 10-year Treasury, risk-free, mind you, because it's backed in full faith of the US government. So if you think there's a risk associated with this, you think that the US government won't pay you back, which they haven't in the past. Some argue they have manipulated it in a way or not, but all of that's aside. When you compare stocks, the risk you take on with stocks, these companies who could go bankrupt, who can't really print money, there's a lot more risk you're taking on rather than just parking your funds in these 10-year Treasury yields and getting this guaranteed return, making stocks look expensive. But the 22 times earnings, expected earnings, look reasonable these days due to the profitability measures that we're seeing with gross margins rising. And when those rise, so do valuations. With aggregate gross margins approaching 50% this year, the multiple of estimated 2026 earnings should be a bit over 20 times. So it's at roughly 20.9 times. So it's close to where it should be, maybe a little bit overstretched, but it's not like way overvalued like a lot of people are arguing. With big tech helping to be the big O boosters that's helping out the earnings coming in, we got Nvidia, Apple, Microsoft, Meta, Netflix, Broadcom, and so on. All of these large tech companies are really doing good profitability-wise. So the market could be priced correctly, potentially. This is also as we're heading into August, which August is marked as one of the best months on record if you look all of the way back to 1928. Volatility is still pretty low, and August is a month where share repurchases are really good. So August is looking pretty well, but September is the month to watch because many are eyeing for September to start changing things in the markets as far as it being one of the worst months performance-wise for US stocks since 1928. And interestingly, that is the month where a lot of people are expecting to see a Fed cut, with the CME Fed Watch tool sitting at just over 50-50 as far as whether or not we're going to get a cut. So that's where we're sitting, 51.7%. Just a couple weeks ago, this was as high as 70%. A lot of the range that I've been seeing it sit in over the past few months of watching this was around the 60% range, and we dropped way below that with just half right now. So we'll keep on watching where we fall with this, but maybe all of this is playing into the market participants disregarding Trump's tariff threats as far as stocks performance. They've ended out up for the day. I believe the S&P 500's notched another ninth all-time high for the year, and the NASDAQ 100 4, but double check all of that. So the tariff threats haven't really shown up yet in the data, at least very much. And then on top of that, and we're talking about optimism for stocks, so tariffs not shown up in the data very much. They could be illegal or at least negotiated lower as far as the Trump taco trade. Then on top of that, the big beautiful bill, the tax and spending bill, helping fund the infrastructure of the economy and cause a lot of spending and allow corporate tax cuts. And then on top of that, deregulation in certain industries. And then on top of that, AI capital spend, all helping push through the uncertainty, because AI could potentially lower costs for companies and then allow them to become more profitable and do better margin-wise. And then it goes all the way back to margin looking good. That increases the valuations and maybe stocks look pretty well. And then on top of that, taco, Trump always chickens out. So potentially all of the stuff that we're facing today could potentially even be walked back. And then that comes to the Powell versus Trump, and Trump saying he's going to fire Jerome Powell, and then he's not likely to fire Jerome Powell. It just depends. But on top of that, rate cuts are potentially coming pretty soon, because we know with this big beautiful bill passing, the government is going to have a large interest expense, and Trump wants rate cuts. He wants them fast. He wants super big rate cuts. He even pointed out that he wants these rates under that of 1%. And he doesn't necessarily say where under percent. Does he want them at 0.9%? Does he want them at 0%? Or does he potentially want them at 0 or negative percent? But on the other hand, bears see that tariffs are higher than expected, that we were expecting at the beginning of the start of the year, and will eventually begin to weigh on corporate profits in the job market at some point, because that's not necessarily the case right now, because everything seems all good in the hood. But check this out though. So we got a survey, and what this survey was really going through, once it loads up, Americans' financial health improved for more than a decade. Now it's taking a turn for the worse. And this article is on Barron's by David Wignall. And what they're going over in this article is that the 2024 iteration of the NFCS, this was the National Financial Capability Study, which this covered the 2024, and it's conducted every 3 years by the FINRA Foundation, found that 26% of respondents spend more than they earn, compared with 19% in 2021. So we're seeing more people spend more than they earn as a percentage. And then note, remember, we said 2024 is the year to note. So why isn't this highlighted? Let's highlight that. Because we've gone places since 2024. Now, we still got high rates. We still got people complaining about inflation. And we got tariffs potentially taking the toll. Like I said, they haven't shown up too much just yet. The share of respondents who have no difficulty paying their bills, so people who are doing completely fine, fell to 44% from over half. So it fell to 44% from 54%. Fully 35% said they probably or certainly couldn't come up with a spare $2,000 if an unexpected need arose, up 5 percentage points compared with 3 years before. Americans are also struggling to save for the future. The fraction of Americans with a rainy day fund capable of covering 3 months of expenses, just 3, like really you got to aim on like 6 months to 12 months of expenses. The fraction of Americans with a rainy day fund capable of covering 3 months of expenses had been rising steadily for more than a decade, peaking in 2021 at 53%. The 2024 figure is back down to 46%, so less than half can cover 3 months of expenses if something came up. The share of parents setting aside money for their children's college has fallen as well. Some of the decline could be tied to inflation, which has lowered household purchasing power significantly since 2021. 2/3 of respondents said that the increased food costs had caused them to cut back on their spending. half said higher costs had lowered their consumption. Interesting. So then they go in to talk about a weakening middle. The FINRA Foundation surveyed 25,500 people, split roughly evenly across 50 states in the District of Columbia between June and October 2024. And what they said is the survey highlights a new trend across many demographic breakdowns such as age and income. Members of the middle group experience similar struggles to those in the lower group. So what I'm getting from this is the middle class is struggling along with the lower class, while the upper class is still booming. They're doing good. They're making all the dollar hollers. Middle and lower class individuals are suffering. So between $25,000 to $75,000 in income suffered similar setbacks in financial health as well as the incomes below $25,000. So people aged 34 through 54 struggled similarly to those of 18 to 34. On a 7-question quiz covering basic principles like mortgages, inflation, diversification, just 46% of respondents got at least 4 questions right, but nearly 2/3 said they had high financial knowledge. So everything's looking questionable. People weren't doing good, or at least doing a little worse financially than they were back in 2024. We're in 2025, and tariffs, even being higher than they were expected initially in the beginning of the year, we're at almost the ending of the year. I'd imagine these numbers, if questioned the same questions again, will increase from where they were at the time of this taking place. But on the opposite end, we had some super bullish news for cryptocurrency. So 3 bills advanced in the House, and investors are really hopeful. So let's go through this. U.S. crypto investors moved a step closer to getting more regulatory clarity after the House of Representatives voted to advance 3 major pieces of crypto-related legislation, and that is today on Thursday. So the main one, the Genius Act, a bill aimed at regulating stablecoins, already passed the Senate. The House vote now sends the bill to the executive branch to sign into law. So this one's right around the corner. Stablecoins are a type of cryptocurrency whose value is pegged to another asset, often the US dollar. And stablecoins, there's a lot of upsides and downsides to this, and we'll kind of go through this a little bit more in future videos. But stablecoins will allow faster settlement, faster transactions happening in between the big banks and then off to individuals. So a lot of people see upsides and downsides to these central bank, not central bank digital currencies, stable coins, because central bank digital currencies, the Anti-CBDC Surveillance State Act, as well as the Digital Asset Market Clarity Act of 2025 still need to be voted on. The Anti-CBDC Surveillance State Act prohibits the Federal Reserve from issuing its own digital currency, arguing that doing so could allow the central bank to track how people use its crypto, monitoring your transactions. The Digital Asset Market Clarity Act of 2025 aims to differentiate what counts as a digital commodity versus investment, which is a real blurred line here, so I'm interested to see how this one goes, as well as delegate what gets regulated by the Securities and Exchange Commission, the SEC, versus the Commodities Futures Trading Commission. So we'll keep on watching this, but this was really, really positive as far as the cryptocurrency goes, because that led more bullishness for Bitcoin, heading right back to the top of this Bollinger Band, reaching as high as $21,000 earlier I seen. This candle doesn't quite show it, but briefly it topped 121,000. And this is yet another milestone for cryptocurrency, giving further support to Bitcoin's rally, up reaching as high as 123,000 just a couple days ago. And then to throw on that, inflows into Bitcoin exchange traded funds, ETFs, have been doing very well. They've been really high, reaching records, while the Bitcoin halving last year reduced new Bitcoin issuance by 50%, making it even more scarce. And remember, there's that cap on cryptocurrency. So there's on Bitcoin. And that cap is at 21 million coins, and there's this halving that takes place every so many years, and when that happens, it cuts the supply of Bitcoin to be mined in half. So that makes it more scarce and leads to less supply of Bitcoin, while inflows are still pretty high and everybody has that FOMO of missing out. So low supply, high demand. What does that do? Support higher prices. Plus, more corporations are adopting MicroStrategy, or their current name Strategies lead. And what Strategy does, if you don't know, is they just keep on piling into Bitcoin. And although these other corporations and big companies aren't necessarily doing that, they're adopting a Bitcoin treasury for their reserves of cash in the light of Liberation Day, which has caused this more de-dollarization to happen. More people are trying to get away from the dollar just with all of the wild moves going on. So, man, we don't know where we're going to go with this, but the future, at least for cryptocurrency, is looking bright, absent a broader market pullback where there's systemic movement and the broader market for assets comes down, at least briefly, before we continue that long line up. And to bring the focus back to Trump and the Fed, bringing concerns about the Federal Reserve's independence, I'd imagine that leads more into both Bitcoin and gold doing pretty well. So I just had that chart up which showed both Bitcoin and gold, and let's just pull it back up so we could look at it while we talk about it. So we see overall Bitcoin was heading up, and gold, I mean, all this year, and pretty much a lot of people are estimating the rest of Trump's presidency, gold has been doing pretty good. And many people already disagree with central banks controlling the money supply, looking at both the dollar's tremendous loss in value in comparison to runaway inflation, so both of those being a problem, leading many people to look for hard money alternatives to serve as legal tender. There's states like Texas and Florida who are leaning more towards making gold legal tender. And then you could ask any Bitcoiner, for the most part, they'd like to see Bitcoin as legal tender as well. So there's a lot of commentary pointing out to people not believing Trump will actually fire Jerome Powell. He's just kind of talking, and he won't actually end up removing him. But the thought of whether or not he would or not, so if he actually would, markets will likely react very badly, playing back on the question, this big old question: is the Federal Reserve actually independent of the United States government? Now, let's look at some of today's data we got. So we're bouncing all over the place, and this is what I like to do because we had a busy day and we like learning on these busy days. So last week's jobless claims came out today, initial jobless claims. And what we've seen is last week's jobless claims fell for the fifth straight week, falling to 221,000. You can see right here. I wonder if I could highlight on PDFs. Doesn't allow me. I think you could just highlight on here. Forget it. So we fell to 221,000 from the week prior's 228,000. And a lot of the expectations of what the numbers we got today would come in at were that it'll increase from that 228 figure the week prior up to 234,000. But instead they fell. So that's looking pretty good. Continuing claims came in a little bit higher. They're trending a little bit higher, coming in at 1.96 million, up from 1.95 million. So they came in a little bit higher than expected as well. But this move isn't really a huge move. Like, it's ticking up and the trend's up, but it's not like drastically going up. But I mean, a lot of people argue the fact almost 2 million people are on unemployment insurance, collecting benefits, and that's really alarming. But overall, job creation slowed, but the unemployment rate is holding steady, and it's what a lot of economists are describing as a, how they put it, no hire, no fire story. So next we got some data in regards to how consumers are holding up. And this was retail sales data that we got for June, which was pretty strong. It came in increasing by 0.6% versus the 0.2% expected. And yeah, 0.6 increase wasn't huge, but you got to note, May declined by 0.9%. So it came in pretty much negative 0.9% for May. We came in positive 0.6, so that's quite the increase, with most of the 13 categories being up except for furniture, electronics, and appliances. So those stores were suffering from lower demand as far as consumer spending goes, with them being down 0.1%. And what this really does is just alarm that there are some cracks in consumers' willingness to spend, and a sign of potential tariff impacts seeping through, because those three sectors, furniture, electronics, and appliances, are sensitive to tariffs. But overall, consumers are doing pretty well. I guess you could argue that tariffs are doing pretty well, not shown up in the data too much yet, but consumers are doing pretty well, but they are penny pinching and looking for deals. Now, how does today's data really impact what the Fed is expected to do? So overall, I'd imagine that this supports a more positive and good view as far as leaning with the bank's message of the U.S. economy is doing pretty well. Jobs aren't being lost, although jobs aren't being hired or created either to a large extent. People are still holding well in the labor market, and then consumers are still spending. So what that will do is steer away the idea of needing a cut at July's meeting. But we got two Fed speakers today. We had Fed Waller and Fed Bostic, and they gave more opposing point of views to really add to the mix of uncertainty. So what we got is Federal Reserve Governor Christopher Waller on Thursday called for the central bank to cut rates on their July meeting. He said that, "I believe it makes sense to cut the Fed's policy rate by 0.25% 2 weeks from now. The risks to the economy are weighted towards cutting sooner rather than later." He said that in the past, his push for rate cuts were based on data, not necessarily politics. And I bet he pointed this out just because of all of the ongoing back and forth between Trump, really just Trump, because Jerome Powell, he's voiced his point of view, but he's not like out loud about it like Trump is. But I'm sure he just slid that out there like, hey, I've been wanting to cut rates. It doesn't have anything to do with politics, because the Federal Reserve's independence is coming into question. Now, private sector payroll gains are near stall speed and flashing red. So a lot of people aren't hiring, although there's not a lot of firing yet. A lot of people aren't getting hired. If you're looking for a job, it's a tough time. And I know people here locally where I'm at here in Oklahoma City, they're having a really tough time finding a job. With inflation near target and the upside risks to inflation limited, we should not wait until the labor market deteriorates before we cut the policy. Tariffs are one-off increases in the price level and do not cause inflation beyond temporary surges. If we cut a target range in July and subsequent employment and inflation data points towards fewer rate cuts, we have the option to hold policy steady for one or more meetings. So he's pretty much saying, like, yeah, like we did see in this last CPI and PPI print, inflation is trending further away from our inflationary target because both of those play into PCE, their preferred measure of inflation. That'll likely go further away from their 2% target. But what Fed Waller's arguing is, hey, that's going to be a one-time increase. It's not going to be sticky. So this will be one time. Usually the Fed's late to the party of cutting. I don't really want to see a deteriorating economy in a tough time and a potential recession or stagflationary recession. Let's go ahead and cut. And if the data continues coming out, all right, maybe we don't cut September, or maybe we don't cut for the rest of the year. But that'll allow us to do that, and at least we cut in July to kind of front run any of these effects. Now, Fed Bostic, what did he have to say? Economy's tariff adjustment could take many months, Fed Bostic says. So he said that the economic outlook remains highly uncertain and that it might take many more months to see how trade policy will shape inflation. And I'd imagine a lot of this will go into this August 1st deadline, what really happens with that, and all of the moving pieces, because now tariff rates are arguably higher than they were Liberation Day. He expresses skepticism for an interest rate cut heading into the July meeting, so he's completely opposite of Fed Waller's point of view. Some immediately started charging, and these are how he argued that businesses in the Southeast have dealt with tariffs in a different way. Some immediately starting to charge consumers or customers higher prices, while others are carrying part of the tariff burdens themselves at the expense of weaker profits. And a lot of companies don't want weaker profits. Like, hey, like, we'll support the lower demand. Let's keep margin high because our valuation is kind of rich right now. On the whole, it's too early to know whether the economy can absorb the blow. Whether new levies will weigh down the consumer economy or whether they will ignite a new cycle of uncomfortably high inflation. He's pointing at stagflation there. Cuts might be difficult in the short run, Bostic said. So he's really, like, I don't know if we should cut. Like, I think we should wait. Trump's back out, like, issuing tariffs all over the place, and they're a little bit high. Stagflation's kind of a wonder, and we don't know if how they're going to impact the data. They really haven't been showing up yet as far as tariffs in the data. Slightly have, but not really. I think we should wait a little bit longer and see how this August 1st deadline hits. And maybe by September, maybe by November, we got more guidance and clarity as far as what's going on. So with all of these moving pieces, what does July look like? Dang near stay the same. It's pretty much guaranteed they're going to stay the same, almost 100%. But that's different from what September's showing, because September's almost 50-50 for stay the same. What about October? I said November earlier. I meant October 29th. October 29th is 50%. Oh, wow. Wow, so it's like people are mixed between whether or not we'll get a cut in September or October, with them both hovering around 50% for just a 25 basis point cut. So I'm interested. Where does that put us for? So overall, the market still sees 2 rate cuts this year of 25 basis points. Now, it's looking like September and October, we might just get 1 cut either of those months. So either September or either October is when we'll get the cut. And then potentially December is when we'll get the second cut. But we'll keep on watching this. It's really interesting to watch because it just keeps going. But stocks are doing pretty good. And while stocks might be smiling today, history reminds us August has a sharp edge. It could potentially be positive. July is a good month. August, we got buybacks come in, these share repurchases. So stocks could do well. Now, I don't know, but between the Fed's division, pressure from Trump, mixed signals from this economic data that we're getting, we're entering a phase where volatility isn't necessarily a bug, it's a feature. Just price it in. Good luck. So where do we go in after August? Where do y'all see us going? What's your opinion? Let me know down in the comments. Let's get some engagement going. Y'all subscribe. Help me get to these 200 subs. I'm right there at 186 subscribers. I really want to get to 200, then 1,000, then 10,000, then 100,000. But I mean, if not, if you're just happy to be here and hang out, I'm happy for that. Like, whether or not y'all subscribe or like the videos, I'm here to learn and share what I learned together. So stay sharp out there, stay skeptical, and I'll see you next time, y'all. Y'all have a good one.